Hey everyone, my name is Jack. The global health crisis has already been terrible. That much is obviously clear. In addition to deaths and serious health concerns, economic damage has been substantial as well. Stock prices have plummeted as investor uncertainty has simultaneously risen. The same thing is starting to happen with real estate, which tends to lag a bit behind the general stock market. Commercial REITs have already been hit pretty hard by the market drop and likely have a lot more room to continue their dip. This, I think, will create a big buying opportunity for those looking to add to their real estate holdings, assuming it's not already a big opportunity already. But maybe you're not comfortable with buying real estate directly since you don't want to manage the property yourself, or you don't want to have to worry about hiring a manager on your behalf, or maybe you just want to get into high-quality commercial real estate buildings without needing to fork over millions of dollars. Now this is the part of the video where I ask you to hit the like button so that I too can get to experience the grace of the YouTube algorithm. It also lets me know that you like this sort of content, so definitely diligently press the like button so I can know that you like this type of content and I can produce more of it for the future. Thank you. Now, in order to capitalize on this potential opportunity, I've created a portfolio on M1 Finance geared towards getting a broad exposure of the entire real estate industry. You can start buying fractional shares of many different real estate companies with this portfolio to start diversifying your real estate holdings with very little effort. It's organized by the different sectors of real estate, including apartments, retail, office, industrial, and others, but it can easily be rebalanced to your risk preference or if you like a particular sector. You can actually copy the exact portfolio by using the link in the description below, and I'll explain the holdings in detail later so you can make your own informed decision. Of course, I have to emphasize that I am not a financial advisor, and this video should not be taken as financial advice. I could be 100% wrong, I could be 100% right, or maybe I'm 50% right and 50% wrong. Only time will tell. Either way, you should carefully consider your options before making any investment decision. Without further ado, let's talk about real estate. So what's coming for the real estate industry? Well, unlike many other businesses, real estate tends to react more slowly to market changes. This is because transactions take a longer time to complete, and rents are typically due once at the beginning of every month. In other words, data lags in real estate. Unfortunately, business closures, often by government order, have frozen commerce all over the world. We already know that. Mass layoffs and a rising unemployment rate have followed that. And battling the health crisis that we have found ourselves in has been very expensive in many different ways. For example, many tenants in both the commercial and residential sectors have threatened to withhold rent or are withholding rent. With April 1st now behind us, some tenants have begun rent strikes throughout the nation. However, the stock market has already dropped significantly, REITs included. If you're not sure what a REIT is, I'll get to that shortly. But in short, many investors are expecting a drop in real estate values, but there likely is still more pain to come, in my view. A number of U.S. states have extended quarantines as news surrounding the pandemic has continued to grow worse. The longer that the quarantines go, the more tenants will be unable to pay rent, and the more tenants that do not pay rent, the more landlords will struggle to pay their mortgages. There likely will be at least a slight, if not a drastic, increase in foreclosures in the coming months, which will affect real estate prices. Mortgage forbearance, which many banks have been allowing due to the government regulations, are rarely a free pass and might only buy a little bit of time for landlords, if any at all. But real estate will not stay down forever. Real estate seems to be primed for a rapid recovery following the health crisis. Of course, it could be wrong, but perhaps even more than the rest of the financial markets, I think real estate is going to rebound very quickly. Whereas many firms may struggle to reacquire customers once the world opens back up, people and businesses will still need a place to stay, and that's where real estate comes in. Either way, the coming months will likely be a fantastic opportunity to buy shares of quality real estate. But how do you buy shares of real estate? Don't you need to own the whole building, you might ask? Well, that's where the aforementioned REITs come in. So what is a REIT? A REIT is a real estate investment trust. It's basically a company that sells shares of its real estate holdings, and rather than buying the property directly, you buy a share of the company that holds the properties, and then you get a share of the rent. REITs get pretty big tax benefits in exchange for distributing the vast majority of their rental income to shareholders. In fact, they're required to. This makes them great tools for building an income-oriented portfolio. However, one drawback as an investor is that REIT income is taxed as regular income generally, obviously speak with a tax professional. But generally, because the REIT itself gets tax benefits at the front end, the government doesn't want to give more tax benefits to the people who benefit from that initial tax benefit, because that would be like double dipping. So they cut it off there and typically require you to pay taxes on the REIT income that you receive as an investor. Another drawback is that you don't actually have direct control over the property management or the day-to-day operations of the building within the REIT, but that's a blessing and a curse at the same time. REITs are also an easy way to get broader exposure to real estate, particularly expensive commercial real estate. They also come with far less headaches than investing in real estate that you own and manage directly, since obviously you're passing that on to the company to do all the day-to-day operations. Now, the purpose of this video is to share with you a portfolio that I created that encompasses each sector of the real estate industry with my favorite brokerage, M1 Finance. If you want to dig through it yourself, certainly click on the link in the description below and you can see all the exact holdings I have in it. And if you already have an M1 Finance account, you could actually copy it into your own portfolio and make adjustments there. If you don't have an account with M1 Finance, definitely sign up using my affiliate link. I do get a small bonus, but they are a free brokerage. And I think they're ideal for long-term investors as it auto-rebalances your portfolio with any cash that you add or dividends that your holdings earn within the brokerage. Be sure to check out my review of M1 Finance, linked above, if you are unsure about whether to use it or not. But I just have to emphasize it is a free brokerage, so it's really of no risk to you to at least check it out and see what they have to offer, since I think they have some pretty cool tools. Anyways, back to the portfolio. Every major sector of the real estate industry is covered by this portfolio. It can easily be tailored to your risk preference and strategy when it comes to real estate. Now, as you can see, this portfolio, which has a broad exposure to the commercial real estate industry, has definitely dipped hard in the last month or two, but then again, so has everything else. The question that has yet to be answered is, where is the bottom? For the long-term investor, this is less important as long as the expected long-term returns of real estate remain strong and steady, just like the rest of the stock market. Trying to time the market is often counterproductive, but it's really hard not to assume that the real estate market will go at least a bit lower as the pandemic continues and rent payments are missed and then mortgage payments are missed. This can allow an investor to get a very high, medium to long-term return on his or her money with relatively high income-producing potential that comes with real estate. So let's take a look at each section of the portfolio now. One of the largest sections is the apartments section. Multifamily properties have been the cream of the crop in real estate over the previous few years. However, given the wave of unemployment threatening rents, the industry has already taken a sharp hit. Cheap debt has encouraged many landlords to become highly leveraged, so there is an additional threat to those who lack the necessary cash. The apartment slice is headed by Avalon Bay Communities, a REIT that owns 79,000 units. Its apartments are spread throughout New England, New York, Washington, D.C., Seattle, and California. And such a large portfolio will undoubtedly be affected by both the down and upswings of the real estate market. I would also expect the upswing to be particularly strong in New York once the pandemic ceases to ravish the land, so Avalon Bay might be very well positioned in the medium to long term. Now, the next sector in this portfolio is the industrial sector. With 25% of the industrial slice devoted towards the blossoming self-storage sector, the rest is split between 4 multi-billion-dollar REITs. With the rise of companies like Amazon and other online retailers, industrial space is critical for maintaining their operations and storage facilities. Prologis Inc., with its $54 billion market cap, along with its 786 million square feet of industrial space, heads the list for this section. The next section is office, and office is divided among 14 different REITs. It will be interesting to see what happens to office space following the health crisis. After all, many workers have begun working remotely out of necessity. Depending on how worthwhile companies feel this arrangement is, they may choose to lower their overhead costs by reducing office sizes. This would definitely hurt the office REIT space over the long run, and this pandemic will be the ultimate case study in how effective remote work can be at scale, and it will fundamentally change the office landscape if it is deemed worthwhile. And the next section is retail, and perhaps no real estate sector has been hit harder by the crisis than retail. Already struggling to combat the growth of e-commerce, retail landlords are now often stuck with closed buildings and tenants with no way to pay rent. The retail slice has a plurality holding in Realty Income Corporation, which is a very popular REIT focusing mainly on higher quality tenants in triple net leased buildings. Realty Income has invested in industrial and office properties too, but retail still makes up the bulk of its holdings. It has a particularly stable dividend and should be able to weather the real estate storm, at least in my view. Otherwise, mall REITs like Simon Property Group are in a do or die position. If they succeed in continuing to transition their malls to focus on lifestyle and entertainment over simple, straightforward shopping, they are primed for a large payout, I think. But if they cannot do so before running out of cash, then they're in serious trouble, just like most of the retail sector. Generally, you can call this slice high risk, high reward. Now, the next slice is healthcare. And the current health crisis has been similarly unkind to senior housing, which makes up a large portion of this portfolio. However, long-term, with America's aging population, one would expect senior housing to do quite well. Oversaturation in this niche market has threatened some businesses, so it'll be interesting to see how firms adjust. The United States healthcare industry is one of the most interesting in the world, and the real estate it uses is always threatened by new regulations or other disruptions. The health crisis may even spur new demand for hospital or clinical research space, increasing revenues for many of these REITs, potentially in the near future. The next sector is the agricultural space. There aren't many agriculturally focused REITs out there, so Gladstone Land Corporation and Farmland Partners occupy the whole slice. Agriculture is a fairly stable business, in much part thanks to government subsidies, though foreign demand swings can add to volatility in this space. Another sector I have is international REITs. M1 Finance allows you to invest in ETFs in addition to individual stocks, so 3 broad ETFs make up the international slice. ETFs allow you to quickly gain market exposure in a particular industry, if not the entire market. The Vanguard Global X-US Real Estate ETF alone has 662 holdings. The FlexShares Global Quality Real Estate Index Fund does include some significant US holdings as well, but overall this slice should give you greater geographical diversity outside of the already robust US market. Another sector I have is the mortgage-backed securities REITs section. Mortgage-backed securities, otherwise known as MBS, are basically baskets of mortgage loans that are divided up into well-diversified revenue streams for investors to then buy. Pension funds are a particularly large buyer of these securities, but you can invest in them directly yourself through an MBS REIT. Each share of an MBS would give you a tiny portion of many different mortgage loans. However, with the growing default crisis, MBS REITs have seen a massive dip in share price recently. And this is because many landlords, homeowners, and other borrowers may be unable to pay their loans, so the mortgage-backed security becomes worth less. Share prices may continue to drop for the foreseeable future as credit risk remains relatively high. One of the last sections is student housing. There's only one publicly traded REIT that focuses on student housing, and that's American Campus Communities. You can look at this as an extension of the apartment slice, since the business models are very similar. The student housing tends to have a greater focus on amenities and rents by the room rather than the unit most times. Rents in many of these buildings are extremely high as demand for college education continues to rise. Long term, this could be an especially lucrative sector. The final section I have is a special one dedicated to Sam Zell. I have a soft spot for billionaire real estate investor Sam Zell. Not only does he have a great autobiography that I've pitched on this channel many times, he seems to be very well positioned to capitalize on the downturn, as he always seemingly is. His 3 public REITs make up this slice. So what should you do with this portfolio? Well, that's entirely up to you. If you believe we're already at the bottom of this dip, then buy now. If you think we still have a long way to go, then obviously don't. Or maybe you don't like the risks associated with real estate compared to other asset classes, so you don't even care. But you still watched the video to this point, so you should definitely give it a like. Personally, I'm planning on investing in this portfolio in stages through the summer of 2020 as the economic crisis likely worsens and real estate prices lower. I'll increase my contributions to this portfolio if I'm unable to find a rental property for myself in the meantime. We'll see if that ends up being a good decision either way. You do not need a massive pile of cash to invest in commercial real estate. REITs make that easy. You're buying shares of the company that owns the building, getting a piece of that rent pie. If you want to use my portfolio of the many different REITs in every major sector of real estate, use the link in the description below, and be sure to sign up for M1 Finance so you can easily import the REIT portfolio into your own account. Then you can adjust it, add or subtract holdings, and fine-tune it to your liking based on your taste for different types of real estate. Everyone's risk tolerance is different and their preferences are different too, and some people might be less real estate biased than I am. But it's always worth considering all of your options whenever you're investing for your financial future. That's all I've got today. Thank you for watching. I hope you learned a thing or two about how you can invest in real estate without actually owning and managing the property yourself. If you did, definitely give this video a like since it helps the channel out a lot. Hopefully this portfolio is either useful or at least interesting and gets you thinking about how you can optimize your own portfolio. If you want to see more content on investing, personal finance, real estate, and other related topics, be sure to subscribe so you never miss any new updates. I post new content every single week and wouldn't want you to miss any of it. But until next time, take care.